A plethora of stories have been written this morning. The weakest bid to cover ratio in 10 years. Was it the Chinese not showing up? Was it the lowest yield and not very incentivized? Or could there be something more malevolent in the message about the fiscal position of the United States? You've got three to choose from. Which is the pig in the poke for you?
Can I have all three, Manus? Look, no, actually, I think
you can have all three because I like you.
You are very generous. So, look, I would focus in on the third aspect here, which is I think yields are too low for where we are in the cycle. I think the market is still pricing in potentially rate cuts, potentially QE4 from the Fed, and I don't see that happening. And I think investors are starting to come around to that view, and therefore, currently looking at 2.4% on the 10-year doesn't offer an awful lot of value. I'm much more comfortable with a bid-offer cover around 2.5, 2.6 than 2.1. It's not indicating a buyer strike. It's just saying I don't fancy that yield if I can get a bit more in 6 weeks' time.
Yeah, and I guess for foreign investors as well, you've got to take into account the hedging costs. That might be another thing feeding into this.
Yep.
How much prospect, though, is there that investors are going to get any kind of a better yield on the 10-year Treasury yield as long as the trade tensions roll on and as long as expectations of a Fed rate cut stay where they are?
Well, on the first one, to be consistent with my comments before the break, I think they will get some better news on trade talks as we get the political cycle in the US turns towards needing a deal on trade. I think the Fed cycle is not going to be an aggressive cycle, but I think there aren't the conditions for a rate cut. The question is how quickly will rates move higher, I think, from here. And in an environment where the ECB, the BOJ are in hyper-stimulative mood, the PBOC in stimulative mood, there isn't a long way for investors to expect a higher yield. But I think you can certainly see a push up towards 2.75, 3% later on in the year as growth starts to pick up. And that's what I'd hold out for.
Simon, what did you make of Lael Brainard's comments in regards to not inflation target, but yield curve targeting, sort of joining that fray with Clarida? Does that show innovation or desperation?
Look, it notes a frustration of persistently low core inflation in the US economy and looking for other things in the toolkit because central banks, and I think Lael Brainard's been, and I've said this publicly in the last couple of weeks, pretty much the best central banker in terms of the commentary over the last couple of years, has indicated that actually you've got to put a bit more meat on the bones. If you say the toolkit is still full, you've got to offer up some specifics on what that may be. I don't think investors are necessarily priced in a change of policy in the near term from the Fed, but the fact the Fed are talking about specifics, I think, does take us a little step forward.